Hi, I'm Pattu from FinCal, and in this video, let's review the performance of Invesco India Contra Fund and also ask, do such contra or value-oriented funds work? So, a few things about the fund. This is a value-oriented contrarian fund. We'll talk about what that means. It was launched in April 2007. It is an AUM of 3,000 plus crores, most of which must have come post 2014. We'll see the reason why. It has quickly moved into the 7th out of 17 value-oriented fund. It has moved into the 7th position in terms of the AUM. So it has got a decent AUM of 3,000 plus crores. Of course, ICICI Value Discovery is it has got the highest, about 15,000 crores, I think, if I recall right. A contrarian fund or a value-oriented fund, you expect it to do well in a sideways market, and as expected, this fund only fell by about 1% in the last year. So there are only 3 funds which did better than this fund, one of them being quantum long-term equity. You can see that in value research if you just look at the last 1 year return. So let's look at the investment strategy. The idea of a value-oriented or a contrarian fund is to find a stock where the associated company is fundamentally sound, but currently it's out of favor, or currently it's going through some kind of a problem, but it's expected to change. The fortunes of the company are expected to change, and it's expected to do well. So the fund manager will try to pick up such out of favor stocks much earlier than other people. So that's the fundamental point in value investing or contrarian investing. So it will also invest in growth companies, but it also and it can invest across market cap, and it defines what can I say, the contrarian bias as it defines. It says its portfolio will have a contrarian bias, and it defines it as companies trading below fundamental value and companies in turnaround phase and growth companies available at attractive valuations. So that's what it essentially defines a contrarian bias as. So it will invest in growth stocks as well, but a bit undervalued. Now there can be 2 types of undervaluation. You can have a growth stock undervalued because the whole market is down, or when the market is actually moving up, the fund may actually choose undervalued stocks or stocks which are kind of down. So then when the market is moving up, this fund may underperform. So that's very important to keep in mind before you actually choose a contrarian fund or a value-oriented fund. It's not for everybody. So the benchmark of this fund is BSE 500 Total Returns Index, and this is the performance since inception. Now, before we get on with it, I must tell you that such fund reviews, I'm doing these fund reviews so that people who do not know how to review a fund before buying or after buying, they can look at these reviews and do the review like the way I do it themselves. All the tools are available for free at FinCal. I'm not having any special means to make these graphs. I'm just making the graphs more colorful, that's all. Other than that, the basic graphs are all available for free. Rolling return calculators, rolling standard deviation, rolling risk calculators are available for free in the website. So my hope is at least 1% of people who see this will have the interest to go to FinCal, download the tools, and do review themselves and be a proper true DIY investor. If you ask me to review this fund or that fund, what I will do is I will start thinking like a blogger or a vlogger. I will start thinking, okay, if I review this fund, will it get more views, or if I review this fund, will it get more views? That is the way I will start thinking. So instead of asking me to review a fund, please try to do it yourself. So this is the since inception growth of Invesco Contra Fund since Nifty, since inception, with respect to Nifty 500 Total Returns TRI. You can notice that for until April or August 2013 rather, there's not much of outperformance at all. I mean, you cannot wait for 6 years for a fund to outperform, even though it's a contra fund. And a contra fund is expected to do well during a sideways phase like this after the recession. But it has not done well here. It started to do well only when the market picked up. That's not a good sign in my opinion. On the other hand, if you notice, look at ICICI Value Discovery, look how well it did in this phase, right? And then because it did well in this phase and the market picked up that momentum, pushed it up even further. Another value fund is Quantum Long Term Equity, that also did quite well during this phase and then it moved up. So that is the signature of a value fund. It should do well during a sideways market. So you should have, it's like a diversified portfolio. You cannot have a portfolio full of Shevags. You must have a Dravid and then a Shevag, because if the Shevags can fail. The Shevags are going to hit, then it will be spectacular. But if they will also fail quite often. More often they will fail, and then you need your Dravid to hold your portfolio together. So value fund should be your Dravids. They should be your during sideways markets they should hold your portfolio in place. So this is the 5-year rolling returns. That is, I'm calculating returns for every possible 5-year periods from between August 2017 to February 2019. That is 1692 5-year returns, 5-year data points in each of those colored graphs. I have used two indices, the Nifty 500 in red and the Nifty Large Mid Cap 250 in green. Nifty Large Mid Cap 250 is 50% of Nifty 100, a large cap stock, a large cap index, and 50% of Nifty Mid Cap 150, a mid cap index. So I believe there is also a decent representation of or an appropriate benchmark for a value-oriented fund. And Invesco's Contra Fund has just about managed to outperform. Managed to outperform both the indices, which is okay. I think it's nothing to worry too much about that. This is the rolling risk. So what I do is, for all those 5-year periods that I talked about last graph, I calculate the monthly returns, and for all those monthly returns, I find out the standard deviation of the monthly returns and I plot it. So there are 1691 standard deviation points in each colored line, and that is a measure of risk or the volatility. So in this case, lower the line, lower the risk. And generally the fund has lower risk than the index, but since about 2017, its risk has been comparable to that of the benchmark, and that's a little worrying, because you can notice that there's a steep fall here. This fall looks a little higher than these two, than actually the benchmark, and that's a problem. And I think that a contra fund is not expected to be that volatile. At least it should have lower volatility. I don't see that happening. Over 10 years, you will see that in the post. Over 10 years, the performance is better, but still over 5 years, this is bad, and I don't. That's something that I do not like. Now we compare the Contra Fund, Invesco Contra Fund, with the blue line, with the white line, which is ICICI Value Discovery, which is like the benchmark of value-oriented funds, at least in India. And then the grey line is the violet line is the Quantum Long Term Equity. You can see the white line, ICICI Value Discovery, has done a very good job. It has outperformed both funds over 5 years. Recently, the Contra Fund has moved ahead of ICICI Fund, but it seems to be falling down and catching up with it. So, but I think this is over 5 years, and this is the rolling returns over 10 years. You can see that ICICI is clearly the leader. Many people claim that ICICI picks this stock, that stock is a problem, and so on. I still think, even though it may be a large cap kind of value fund, I still think it is a good pick. I've recently reviewed it. I think it's a good pick. Quantum Long Term Equity is also a decent pick. Over 10 years, you can see there's not much difference between Contra and Quantum Long Term Equity. Just a little bit a seesaw battle, going up, going forward. So it's not much difference. If you look at rolling risk, both the Value Discovery and Quantum Long Term Equity have lower risk than the Contra Fund. Again, over 5 years, over 10 years. So I think they are better choices. If you're a new investor, those are better choices than Invesco Contra Fund. So, do Contra funds work? They choose out of favor stocks, which means the portfolio will not zoom up. When the market is zooming, it will not zoom up. It will not do well. It is expected to do well in a sideways market, but not all the funds do. For example, Invesco Contra Fund did not do well in the previous sideways market. I think its testing time is just now begun in the current sideways market. We will now know whether it is behaving well or not. So I think it's still new investors can wait and watch. There's no hurry to invest in this fund. Just let's see, give it some more time and let's see how that works. Also, contra funds means that people should be patient. Most investors are not patient. This means it is not suitable for many people. It should be a part of a diversified portfolio. It should be one player in the portfolio which kind of bolsters the portfolio and supports it during volatile periods. Not all the funds do it, so you should be careful when choosing it. So that's very important. Also, another misconception is I see that because they like value investing, they read Warren Buffett and other people, and they read about it, and they think that because they like value investing, they think that value investing in direct equity is the same as value investing in a mutual fund. That is not true at all. In a mutual fund, especially in an open-ended mutual fund manager has got several restrictions, problems, or dealing with inflows, outflows. There will be problems because the distributors will come and complain that we are not able to sell the fund and so on. So because the returns are poor. So it is not the same. You cannot assume that you will just buy and hold stocks and then everything will be alright in future. That it doesn't work like that. So you got to have that maturity before you choose a value oriented or a contra fund. So I think I've just summarized. If you're an existing investor, well, don't exit just because of this video. Just keep an eye on the performance, and if it doesn't do well in a sideways market, get rid of it. If you're a new investor looking for a contra fund in your portfolio, and you understand what you're doing, then quantum long-term equity and ICICI Value Discovery are better picks than Invesco Contra in this case. I hold quantum long-term equity. I also hold Parak long-term equity, which is also in a way a value-oriented fund. I forgot to include Parak in this video and also in the post. But you can do it yourself and see how that works. But I hold, for me, volatility is, see, for me, I don't want 20% return and then suddenly dropping all the way to 10%. I want steady returns. It should not fluctuate. Can fluctuate maybe like 9%, 11%, 12%, 15%, maybe maximum it will go to 15%. So what I am tracking is the volatility in the return or overall return from my portfolio. That should be low. Therefore, I choose funds like quantum long-term equity and ICICI Value Discovery. Most people will say they're useless funds. I don't care. I am not most people. So, and you can choose such funds only if you're not most people. That much I will tell you. So, that's what I wanted to say. I think there are some more fund requests that you made. If you have, I'll keep them in mind. But if you have some more funds for me to review, leave a comment. I will review. But please remember what I said. All the tools are free. Use the tools and do the review yourself. You will be a much confident investor. So I'll catch you in another video. Thank you as always for watching. Have a good week ahead. Bye bye.